Pain plus reflection equals progress. Only two things that you need to do in order to be successful. The first is you have to know what the right decisions to make are, and then you have to have the courage to make them. And most people don't have in their heads the right decision. And I think one of the greatest tragedies of man is that they hold on to opinions in their heads that are wrong, and they don't go out there and stress test them. Rather than thinking I'm right, I went to thinking, how do I know I'm right? And it created this open-mindedness to be able to then go find the smartest people who disagreed with me and to see how they would think about things, to balance my bets better. It taught me that the power of radical open-mindedness and an idea meritocracy is such a powerful thing. Pain plus reflection equals progress, right? And I began to develop this knee-jerk reaction. Pain is a signal that something is wrong, that you did something wrong if you make those mistakes. And then to take that pain and to calm oneself down and think, what would I have done differently in the future? So my instincts change. I view those experiences now like solving puzzles that'll give me gems. The puzzle is, what would I do differently in the future so I would get a better result? The gem is the principle that I would write down as I learned it. So literally, by writing down the principle, when this one comes along, what do I do with it? Everything is another one of those. Like we have a million of those. And if you start to say, when one of those comes along, how should I best deal with it? And you write down that recipe, those are the principles. So I found that exercise to be great. Think about your savings and how much money do you have for savings. And the best way to think about that is to think, how much money do I spend each month and how much money do I have saved so that how many months am I going to be okay without that? And to value savings, right? And calculate it, because savings in that is freedom and security, and think about what that is. So that's the first. How much do I have for that? The second thing is, how do I save well? What should I put my saving in? And when thinking about what you should put your saving in, realize that the least risk investment that you think from volatility is the least risk investment, which is cash, is the worst investment over a period of time. And you could judge that by judging the rate of inflation in relationship to the after-tax income you're going to earn. So if you have an inflation rate that's 2 or 3% and you're earning 1% and you have to pay taxes on that 1% or the 1 or 2% that you're going to get, you're going to get taxed essentially at 2% a year, and that's going to be a problem. So you have to move into assets that are other assets that are going to do better over a period of time. And when you do that, the most important thing I can convey to you is to diversify well. Because I can guarantee you that one of those assets, and you won't be able to pick the right one, will be disastrous in your lifetime. That you will lose half of that savings if you're in the wrong one, and you won't know what the right one is. And so pick different countries, pick different asset classes, and I could probably take too long explaining how you might do that. But so that would be the second thing to learn. First thing is think about how to save. Be cautious about debt. When you're thinking about debt, think about, is that debt going to help my savings or is it going to produce an income? Sometimes debt, like buying a house or buying an apartment or buying an asset, it produces forced savings. Forced savings is a good thing. Or if you're taking on debt and you're thinking, am I going to have that debt in an asset? That asset better produce more income than the cost of your debt. If you're using debt for consumption, that's not a good thing to do. Okay, you're giving up that safety. So number one is think about how much you save and think about whether that should be and how you borrow. Number two, Make sure that you think about the diversification of that, not in cash. And number three, do the opposite of what your instincts are. If you're going to play the game, it has to be the opposite of what your instincts and the crowd says, because the market reflects the crowd. So you want to buy when no one wants to buy, and you want to sell when no one wants to sell. First of all, an investor must understand that they probably will not be able to play the game well. They probably will not be able to decide how to move in and out of things. In order to be successful in the markets is more difficult than getting a gold medal in the Olympics. You wouldn't think about competing in the Olympics, but everybody thinks they can compete in the markets. But there's more money competing. It's like a zero-sum game, and there's more money doing it. And the worst thing you could do is think you can time all of these movements. If you could, I guarantee you the game's a tough game to time. We put hundreds of millions of dollars into the game every year, and it's tough. So what the individual investor needs to do is know how to diversify well. So the word that I would know how to diversify well and in a balanced way. The greatest mistake of all investors is to think that what has done well lately is a better investment rather than more expensive. And the greatest, and what has done worse lately is the worst investment, get me out of it, rather than it's cheap. And unless you know how to deal with the differences of those, which most people don't, they're going to be in trouble. So understand that wealth, total amount of wealth in the world, essentially doesn't change very much, okay? And that one thing goes up, another thing goes down. And to know how to diversify it in asset classes, to diversify it in countries, to diversify it in currencies, to know how to diversify that well so that you have wealth diversification is important. Do not think that cash is a safe investment. Most people think, look, I just want safety, and those bonds aren't giving me an interest rate and so on, so where do I get safe? Cash is a seductive investment because it doesn't have as much volatility, but it taxes you in your buying power about 2% a year. And so, so cash is almost always the worst investment. So you have to think about that. You should think a little bit unconventionally. Do you have a little bit of gold? Do you have a little bit of asset in case this monetary system breaks down and money's redefined? Do you have a little bit of that? I can't get into all the different ways that one can diversify well. I try to convey those things in my books or on posts on LinkedIn particularly. But I would say diversify well, be humble, don't market time, and be conscious of the dangers of cash.